What's up, everybody? It's the Digital World Podcast, and we're back at it. 6.34% for 30-year mortgage rates. We are climbing up, and so I do think with the um, Fed decision coming up here soon, October 29th, which is 3 weeks from now, which makes sense why some of the markets are acting the way they are. I think maybe they're waiting in anticipation for that um, Fed rate cut to come on in. Um, I know usually by the time the um, Fed rate cut is announced, either it could be front ran with the decision, or um, it could be front ran, and there's a lot of volatility. And what you'll see is, you know, the initial move, which could be up, right, followed by the real move, or the real move is the first one. Then you have the decline, um, and then you go back up to what the real first move was. So we'll see. We'll see what happens if there is a front running of the Fed um, by the time they announce their decision, which there's a 92.5% of a 25 point basis point rate cut, and a 7.5% that we maintain rate. So looks like highly likely we'll get that Fed rate cut. Now, as you can see, the 30-year mortgage has ticked a little higher, kind of just trending here. Again, these moves don't happen in a drastic way. Um, and so, I mean, we basically dropped about 40 basis points from where we were last time before the rate cut. And so now here we're seeing, again, folks, 30-year Treasury bond has basically maintained itself around that 4.7-ish level. Again, I'm not concerned with, small moves of that sort, right? You zoom out from a 5-year standpoint, and you're seeing it's just been making lower lows and higher highs, right? And we've been kind of stuck, I would say, in this range since 2023. And by the time this breaks out beyond that 5% level, I think there's going to be issues, right? Uh, if I zoom out here, we've been just consolidating, just getting tighter and tighter and tighter. And as of now, I think equities are going to go higher in the short term, um, just because of the the environment in which we see, growth in the economy. Right, GDP is above 3%. Um, we see uh, equities, right, at all-time highs, and then we're cutting rates. And so right now, I think, based on some analysts who post information, they're saying, in this type of environment, uh, money is flowing further down the risk curve. And so you're going to see equities go higher first before they come down. So it's essentially, you can call it an engineered melt up, right? Um, and where you're going to see a crack up boom in equities. So I think that comes first. Doesn't necessarily mean the same for homes, right? This is specifically equities. I know there's a lot of signs out there of cracks in the economy, but for example, one of them being the construction sector, right? The job openings rate for the construction sector has fallen 2.2%, the lowest since November 2015. At the same time, we've seen home builder sentiment, right, bounce off the lows from April. So we're going to see where this all heads, but I do think, like I was saying, all this, there's the there could be one last final push. How that, how long that lasts is going to be, it's going to be something we're going to be monitoring. So, with that in mind, stay vigilant. Thank you for watching. Like and subscribe to the channel. This is the Digital World Podcast, and I'll see you in the next episode.